Hello traders, James Stanley with StoneX and Forex.com. It was a back and forth month of November for the USD. The dollar came into the month with a full head of steam after showing a Morningstar formation on the monthly chart. And that strength continued through the early part of the month when we had a test of a really big resistance level. That resistance held, brought a pullback. Buyers did show up at a higher low though, and they drove right back into that resistance. And then we had 5 days of test before they faltered again. With that said, I think there's still an argument to be made on the bullish side of USD, and I want to go over that in this video. I also want to look at the alternate scenario of where I think dollar weakness could be most opportunistic. The big item on the radar now is the FOMC rate decision in December. That's in 2 weeks, and Saturday marks the start of the blackout window for the Fed. So we shouldn't be hearing from Federal Reserve officials opining on policy, which is a major factor right now. But let's get to the chart, start chopping this up, and devise some USD strategy for the week ahead. So first and foremost, like I said, we're at a massive resistance level right now. This 100 spot 22 level is what set the low last year when the Fed started cutting rates on September 18th. Now, you'll notice the pricing in of rate cuts brought up clear and decisive short side trend in the USD. Actual rate cuts themselves, not so much. The dollar reversed hard in Q4, and even as the Fed was cutting, the dollar rally continued and continued and continued. This year, there's been a similar script, albeit with some differing time, and notably, the response to the falling wedge has been not nearly as emphatic as what we saw last year. Last year, strong, clean breakout reversal that took over just as we opened into Q4. This year, the falling wedge took longer to build. That low was set when the Fed started cutting rates on September 17th. And that's led into a series of higher highs and higher lows. That continues today. That's why I think there is still a bullish argument to be made in the dollar. But notably, that same 100 spot 22 level is what has held the highs again after holding the highs in August, holding the highs earlier in November, and then this 5-day sequencing until we finally had a pullback. Now, with that said, if we match this with the headlines, I think there was an open door for bears to make a larger move. We have had the build of expectations for a rate cut in December. If we go back just a couple weeks ago, that was a coin flip. Now, markets are showing like an 86.9% probability of a cut in 2 weeks. Bigger picture, however. There's still wide expectations for another 50 or 75 bips of cuts from the Fed next year, and that was the factor for this week. This week, Kevin Hassett, the director of the National Economic Council, was named as the front runner for the next Fed chair position. Noted policy dove. He was handpicked by Donald Trump for this role in his administration, and the fact that he is now named as the front runner for the Fed, front runner for the head of the Fed, from U.S. Treasury Secretary Scott Bessent, I have a hard time imagining how that is a bullish USD item on its own. The fact that the dollar didn't sell off larger on that news, I think is notable. It's those deductions that make price action so utterly interesting, because if a market stops rallying on good news, then it's probably because everybody that wants to be long already is. And they start to take profits, and as that good news doesn't bring continuation, there's more and more reason to take profits, and then that's what leads to reversals. Well, it could work on the way down as well. You'll notice that the rate cut dynamic that got priced in really well in the first half of the year hasn't brought a lot of ammunition lately. And more to the point, that's exactly what played out last year. The pricing in of rate cuts was strong. Actual rate cuts themselves, not so much. But this chart is notable. Give me a second to line this up. It's this one. What I'm looking at here, these are FOMC rate decisions going back to the beginning of 2024. The dashed lines are non-quarterly rate decisions. The solid lines are quarterly rate decisions. Quarterly rate decisions also come with updated guidance and projections, so the Fed gives us a lot more to chew on there. And you'll notice, even with the Fed being in a cutting posture, the general sense for many of these meetings has been USD strength in the immediate aftermath. Now, that's not the only thing driving the dollar, of course, but we could go back to early 2024. The reaction shortly thereafter, dollar strength, and then we have another factor that comes in and brings the dollar right back down. The March meeting in 24, same thing. We get some weakness on the back of May, strength on the back of June, and that's when the Fed started cutting rates last year. That's when the low came in, that low that's now the current resistance level at 100.22. But then November and December, decisive bullish reactions to those FOMC rate decisions. When we get into this year, again, the expectation for rate cuts has been drove the dollar lower through the first half of the year. But the January rate decision, that brought a few days of strength until it eventually was faded. And then the March rate decision, a few days of strength until it was eventually faded. The June rate decision, I think, was a really good example. This one doesn't look too positive. But if you go back and look at the way this played out, the initial response to the rate decision was strength. And then it was the next Monday when Michelle Bowman, who's been vying for that Fed chair position, had a comment in the media early Monday morning where she said she was ready to cut rates in July. It kind of like hijacked the conversation. The dollar put in this bearish engulf and then pushed right down to that fresh low. But the immediate reaction to the Fed rate decision, strength. And then July, this is where Powell said he didn't think that markets, the policy was overly restrictive. Strong reaction to that rate decision. The NFP report thereafter pushed it right back down. But since the Fed started cutting rates, September, October, decisive bullish reactions here in USD. So this, I think, puts more focus on the inflation factor, because if we go back to those rate decisions, when Powell said this was a risk management move, it highlights the fact that the Fed doesn't really think the economy is in dire need of more softening. But markets are building that in because they're anticipating that eventually things are going to change. But what I'm more interested in is this reaction. The higher lows and higher highs that have built ever since the Fed started cutting rates back in September. Now, if we look at this from the daily chart, I can still make that bullish argument that we have a higher low holding at a prior zone of resistance, right from like 99.32, 99.40, up to this 99.56 level. So prior resistance back in June, resistance earlier in October, now coming into support to help hold the lows. Last week, or 2 weeks ago rather, we had this hold right at a clean Fibonacci level of 98.98. This is why I think 102 is that big picture target if we do get that breakout hit. But 100.22 is the level because it had 5 consecutive days of resistance, and you'll notice if you go down like really granular, it started to break a little bit more. That initial pullback held support at 100. We went back up. We set a fresh high. They went for another shot, and then they just kind of lost momentum, and then we got the deeper pullback. And then the deeper pullback, again, was guided by a couple of bearish USD factors, but that's what makes this a really interesting overall scenario. Now, if we are going to get a deeper breakdown in USD, I have a setup that I really like for that, but I want to look at something else first. I want to look at what I consider to be the major spoke in this wheel. It's the euro. The euro is 57.6% of the DXY quote. And as we've had this resistance test in USD, I've been highlighting this as a major factor behind that push, behind that move. And that's the 115 level in euro dollar. Euro dollar does not usually just give way with 115 easily. You'll notice back in 2015 to 2017, when we had the pair ranging, 115 was resistance, 105 was support. Multiple iterations where breakouts failed, prices pulled back. We meandered back in the range. And then even when there's motive on the fundamental side, it could slow the move for months. It comes into support in May of 2018, shows resistance January of 19 before sellers are finally able to take control. COVID, the peak of pandemonium is coming in. 115 is that line in the sand that bulls just cannot get across. Again, fundamental motive in 21, 22, when markets are gearing up for the Fed to start hiking rates. Slows the move down. It's the last kiss of lower high resistance before Eurodollar plunges through parity. More recently, 115 is what brought this pullback back in April. We have that initial run of USD weakness when we have that bad economic data of the US. Right there. High holds, 4 weeks of pullback. And then that becomes a zone of resistance that it takes bulls a while to finally get through. Now we're seeing this on the other side of the matter, where it's been support a couple of different times so far in the month of November. And I was looking at this in a webinar earlier in the month, and we had that first breakout test in USD. And as I warned then, this is a tough type of backdrop to chase because 115 doesn't usually just give way that easily. Well, lo and behold, that's what set the low last Friday, and that since led into a bounce. Now, if I look at this from the daily chart, much like that USD setup, the mirror image of that USD setup, I can make the case that this is bearish price structure. We had the first Fed rate cut right here. That led to this pullback, which at the time was a higher low, but then that was a lower high, and then a lower high. This rally finds resistance, 5 consecutive days of resistance at that Fibonacci level. Lower high to a lower low. Lower high to a lower low. In November, we had another lower high post in here. Another one of those areas. This is one of those tell me areas. Bulls have an open door to go for the break. Not only do they fail to do so, they shy away just like 13-ish pips before the prior lower high. That retains bearish structure, and sellers went back into the mix. A decisive run down here until that 115 level comes into play again. But that's the spot right there that bulls need to beat to take control of this thing on a bigger picture basis. If we get a break above that, then I imagine that we have a break in DXY below 98.98 and maybe even below that. That bullish structure in DXY is not going to look so attractive if we get a bullish breakout here. Until then, I think there's still a case to be made on the daily chart for bearish price action in euro dollar. It just so happens as we go into the weekend, as we go into the end of the month, we're holding at a really big spot. It's that same 115.93 level that I looked at in last week's video. So this is one that I think could still cut in either way. But the reason that I think USD strength is still the bias here for now, notice this. We're just inside of that mid-November swing high. If we look at the USD against the British pound, however, pretty different argument that could be made right now. And again, I looked at this one in, in early November when we had that first breakout test in USD. And at the time, cable was in a pitiful spot. I mean, this was its most oversold on the daily chart in more than 2 years. We had just seen this stall right at that 130, just above that 130 handle. But as I covered in webinars in the week since, the bullish build here has been quite a bit more attractive than what we have in euro dollar. And as a case in point, the mid-November swing high right here has come in as higher low support so far today, over the last 2 days, technically. So if I'm looking for USD weakness, I still like this one better. I think it's more attractive because at least I can make the case that we have bullish structure building on the daily chart. 4 pullback levels. There are a couple of different resistance spots that I'm pulling from a shorter-term variation of this, like 31.86 is a support turned resistance level. Hasn't yet been retested for support since the recent breakout. That's what I would consider like S1 right now. A little bit deeper, 3140 is right down here. And then below that, 31 to 31.17. This is what I'm looking at as like invalidation. If we get below that, it's not necessarily that bulls are done for. We could technically see a higher low off of this trend line, but that's the level that I want to see buyers retain to keep the door open for bullish setups. It was resistance over multiple periods here on the 4-hour chart. Hasn't yet been or shown much for support since the breakout. This is the one that I like for USD weakness. For USD strength, it's still the dollar yen. And you can even strip the dollar out of this and maybe look at pound yen if you did want to avoid USD setups. But what I like about this one is if we look at that DXY backdrop and the fact that the dollar is still at that same resistance that's been in play for months, you look at dollar yen, it's been quite a bit healthier over the past 5-6 months. And then there's been a concerted yen weakness bias that's priced in here. The challenge with one of these moves is it could fast get overbought. And then it becomes a chasing proposition. Now, again, look at this last Friday. We had this pullback. And I thought this pullback was more of like a squaring up ahead of the weekend, given that we had another one of those explosive trends, those rallies, and the fear that maybe there was going to be an intervention threat over the weekend, so we simply saw longs taking off some exposure before we went into the weekend. That pullback continued for a bit, but notably is right down here around that 156 level that we saw buyers continually come in to defend. Now, it's still not game over there, because you'll notice we still can argue that there are lower highs. But from this daily chart, if we do get that deeper break, it's this 154.45 to 155 area that I think just really stands out as a prominent spot of support. If I get that, I still like bullish continuation dollar yen. I think this is still going to be the most attractive long dollar component until we finally get that intervention threat, that big intervention threat, and perhaps even an actual intervention. Because if we look at prior episodes of intervention, like what happened in 21 to 22, there were multiple threats along the way. It stalled the move at 145. The BOJ finally intervened at 150. That really just put bulls on their back foot. And then weak US data is finally what caused this to fold. Similar here, where BOJ intervenes at 160, that really just brought a pullback, and we went right back to 160. So if we do get that intervention, I think we get a sizable pullback. Whether it brings a reversal or not, I think that's up to US data. But that's a factor that probably won't be important until next year. For now, it's all about FOMC. It's all about those rate cut expectations. And it's all about the way that the dollar is going to perform against the euro next week. But that, my friends, is what I have for this week. I want to thank you for your time. And as always, happy trading, ladies and gentlemen.